Hello and welcome to Capital Management's weekly roundup. Following a great week, a week we saw the risk button remain firmly on as a fundamental shift continues, a shift to risk on trades, a move to high yielding currencies at the expense of the low yielding, driven by a rise in relative interest rates, notably the euro this week, currently due to cost push inflation, but in the medium term due to a faster speed of economic growth and demand led inflation. But a shift that is also punctuated or exaggerated by shocks, Middle Eastern instability and therefore commodity prices, earthquakes and intervention, the flash crash stock market correction, and this week, a US government shutdown. Currently, the euro is clearly the main beneficiary and the yen the main victim, which is why we highlighted the break of 116 euro yen last week. It is the dollar that is the most difficult and contentious. We believe economic growth will ultimately benefit the dollar. But until there's a sign US rates will rise, it stays in a blowout phase against higher yielding currencies, with only the yen, Swiss, debatably sterling that have turned or turning. This is reflected by the dollar index, or better named anti-euro index, continuing a speculative bubble beyond this week. Dixie duly broke to new lows, and despite the Armageddon many are calling, the long-term chart shows that it's basing, and currently in the last leg of a declining wedge to an ideal 73.28 C=A target that will easily hold the 70.60 low until it reverses back to 88. This is supported by a June 2009 euro analogy that still projects 146.30 as a potential top. But there are four things that will help decide whether the euro or the dollar will benefit most from risk on. First is the trailing stop at 142.45. If and when this yields, we will be confident it's reversed. Second is game theory. The market's very bullish, the euro, but are they long? Or is it a double whammy? Doubly augmented expectations, where the market's very bullish, but not long, deterred by this extreme sentiment, so has a capacity and willingness to buy even higher levels, turning a drift into explosion beyond 150. Or a triple whammy. Triply augmented expectations, where we think the market isn't long because of this and join an already long market overshoot into a bull trap at 146.30. Different views. What's yours? Mine's a triple. Third is the long euro cross hedge. This is a euro, not a dollar move, and we're happy to remain long euro crosses. Euro yen, although it should react from 124.50 to as low as 120 again, remains on course for 128 and 150. Euro Swiss is set to break the 132.35 high for 134 and a final 137 corrective target, consistent with our euro view. Euro sterling has pulled back to the broken weekly trend line and is now ready to take out the 89.40 high to accelerate the emerging uptrend. Fourth, the other dollars. Dollar yen remains in an uptrend to over 90, but should react from 86.70 to provide another buying opportunity around the 84.50 breakpoint. Dollar Swiss did fade over 93 to allow a chance to buy below 91 for acceleration through 93.40, probably on the back of the dollar and cross strength. A break of 89.40 on euro sterling should maintain an expanding wedge reversal formation on cable and the threat of a larger decline. Failure to break 89.40 though would risk cable joining the euro in a move towards 177. The commodity currencies have stayed with the euro in a blowout. 107 Aussie remains viable short term, but remember we have held the final 110.75 C=A target for a year now, and the C=A objective on dollar Canada 94.50, pretty close. Their fate does depend on the speculative commodities, and although gold is so close to our 1478 target, we need evidence it's turning, at least shorter term, and will not join the cyclical commodities such as copper that are destined to trade higher in the longer term due to economic growth. Remember, it's the prospect of economic growth that we believe is pushing the risk on button, but will also maintain the stock market uptrends, particularly we think those with the weakest currencies. Once the Nikkei establishes above 10,000, yes, we do see 20,000. There will be times when the risk button is paused. So to find out how to profit from further excitement in the markets this week, follow us on marketvisiontv.com, or while my colleague Don Haynes is away, just me, Ed Matz, on Twitter. Good luck, and of course, have a great week.